but it doesn't disguise the fact we got a miserable quarter.
A miserable quarter, and ending with what looks to be a very large dollop of short covering, both here and in Europe.
Last few days in the US, although the market went up with the exception of yesterday, every day they were more declining than advancing stocks, and the list of 12 months new lows was very high. On Friday, over 200 shares made 12 months new lows, and very few shares, less than 60, made 12 months new highs.
The Standard & Poor's index headed into the last day of the third quarter down more than 9%.
Chaotic trading has wiped out over $5 trillion off global stock markets in just the last 2 weeks. And I'm joined by RT's Katie Pilbeam to give us some insight into this. People are already calling it a bloodbath, Katie. What is going on with the markets?
Absolutely. The markets are taking a bruising, an absolute beating. We've got red across the bourses today. It all kicked off in Asia. That's where it started. And now we're seeing the ripple effects in Europe, in London. American futures are down as well.
So it shows you a lot of stocks are already declining. There are more stocks now below the 200-day moving average than above the 200-day moving average.
So it really is a global bloodbath, as you say. We've got the markets plummeting. Why? Well, it kicked off in China. So the macroeconomics there are not looking great. In other words, the economy is slowing.
China's stock market faced its second bloody Friday in a row. The blue chip index ended down nearly 8%, and it's down by nearly 20% from a peak 3 weeks ago. I'm Reuters correspondent Pete Sweeney in Shanghai. For Chinese investors, the concern about this dip is that it's the beginning of a long slide downwards. A lot of investors are worried when they look at the central bank that the government is getting ready to turn off the monetary taps that have driven this rally so far. For foreign investors watching this, it's not that big of a deal in terms of the stock market valuations themselves, since not a lot of foreigners own Chinese stocks. The concern is that a stock market collapse this year, as the rest of the Chinese economy is struggling to recover, might damage Chinese consumers' confidence, their willingness to buy other things, and by extension, buy things from foreign companies that depend on Chinese consumers buying their stuff.
Yeah, I think there's quite a fair bit of government institutional support coming in the late afternoon to actually shore up the market, and whenever the market's actually down to the 3%. And therefore, we think that that's the kind of market that you don't really want to get into right now, especially where the A shares are concerned. We expect the volatility to continue because you get the margin redemptions, you get the fund redemptions coming through, and therefore we don't expect the volatility in the A share markets to actually die off anytime soon.
I wouldn't say that's the absolute extreme, I would say, for the time being. It really depends on how the authorities get to grips with things in China, because you've got this. The fundamental problem with China is the authorities have bitten off far more than they can chew. They realise that their economic growth model is no longer fit for purpose, so they need to rebalance the economy.
It's funny, Jackie, because I think everybody does know how the China thing plays out. We just don't know when it's going to play out. The China thing plays out. We just don't know when it's going to play out. The question becomes, is this the day of reckoning from decades of artificially propping up markets? And I'm not sure that it is, but it's a scary notion. The fact that we had a risk-on day last week just based on the fact that China said, no, you can't sell our stock market anymore, that seems like the actions of a desperate administration. To me, I'm worried about China. I think they could have a big impact, and I probably expect another leg lower there.
Katie, what about oil prices? We know they've hit a 6-year low. What's driving the plunge there?
Yeah, we haven't seen this since March 3rd of 2009, so testing new lows. $41 and change is where we stand, a 4.5% slide. We actually are seeing production continue to flatline, so no sign that we're actually seeing a meaningful decrease there. The problem is also demand. Traders are telling me that as the summer comes to a close, they are expecting demand to come offline here.
The low 40s to the high 60s, and now we're heading back to the low 30s. I think reality is finally starting to bite. We're oversupplied. We've been oversupplied for over a year, and we now have demand worries starting to come into the marketplace. And if we don't have any global demand to really mop up the oversupply, then we're just going to continue building inventory and pressuring prices until something breaks.
And you have to go all the way back to the third quarter of 2011 when the index plunged more than 14% to find a lousier quarter. Even with the early rally on Wall Street on the final day of the quarter, that grisly statistic won't change. By now, most investors know why stocks are suffering through their first 10% correction since 2011. China's economy is slowing.
Are seriously on the brink of another extended leg down.
If you look at what's happening in the emerging markets, if you look at what's happening with China, it's hard to imagine that if you add up all these economies, it's probably about half the global economy.
Sure, absolutely.
If it's getting sick, it's hard to imagine that's not contagious to us and to Europe.
So I think in the US, the market could easily drop 20 to 40%, easily.
So it's a black Monday for us all, a bloodbath in the markets, and oil prices are helping to drive down the global economy.
And as you opened with, the other key is to keep an eye on crude. Below 45, maybe some pressure on stock. Well, October's historically the month that you make bottoms. So the real question is, will it be early in October or late in October? My gut kind of tells me it may be late in October. Everybody's hoping it's much like 2011, which was very early in October, on the 3rd or 4th. So we'll cross our fingers and see. But oil's going to be a factor, and if selling resumes in the biotechs, that'll be a problem too. I still think we may be in for a retest of those August-September lows.
There's angst over interest rate policy and when the Federal Reserve will hike rates for the first time in 10 years. Add to those woes a meltdown in the commodities markets and growing fears that stocks have climbed to unsustainable valuations, and what you get is a really lousy market. Those worries have sparked a big sell-off that has knocked more than half of the stocks in the S&P 500 index down more than 20%. The final 3 months of the year will be wild.
So when you look at global growth and you look at the BRICS, the big saviors of global growth, we've got Brazil in recession, down probably 2% on GDP. We've got Russia in recession. India's plodding along, and we think that China, on its industrial side of things, is closer to 0 than closer to 7. And so when you've got that backdrop and you're supplying probably 2.5 million barrels a day higher production of crude oil than we were at this time last year, you're not balancing the books. So it's obviously getting a bit crazy today. It's a wild day, and so it's a tough time, but we're on the way to new lows, and we're going to hit the 2008 lows.
Now it can conceivably go to $32 a barrel into the fourth quarter of this year. Global oversupplies remain. We continue to see crude oil going to tank, but area in particular is the U.S. crude market. We lose 1 million barrels a day of crude demand as refiners go into maintenance.
Oil prices are recovering some of the losses sustained over the weekend, but remain well below the $50 mark. The global benchmark Brent crude is currently trading around $49 a barrel. That is over 60% lower than it was just a year ago.
Obviously, we're getting into some really scary areas. I mean, if you look at OPEC has pretty much done what it said it would do. It stopped the shale growth. It stopped the non-OPEC growth. I mean, nobody is out there looking for oil today. 100,000 or more people have been laid off. But what it's done as a side effect is it's really hurt some of its members. Venezuela is in disarray. And if you look at what happened in 2011 when we saw Libya break down, take 1.5 million barrels a day off the market, then Venezuela with 2.6 million barrels a day on the market.
Now, other markets, they are already down substantially, like Brazil or emerging markets in general.
Brazil is in bad shape because investment in Brazil is very low. You have a lot of uncertainty ahead of elections in October, and investment actually fell 5.3% in the last quarter. So companies, instead of investing, are buying back shares. They're increasing dividends for their shareholders. Nobody wants to put money into the economy. So that has really hit the economy. Interest rates in Brazil are 11%. They're the highest in the G20. So they've boosted them a lot because they need to control inflation. What you have in Brazil is stagflation. You have an economy that's doing badly, and you have inflation that's very high, 6.5%. It's above target for 4 years now.
Is hitting oil-rich Saudi Arabia. The kingdom is selling government debt this Monday, reportedly worth more than $5 billion. Commercial banks will be allowed to join the bid for the first time since 2007. For more on the significance of this move by the Saudi government, let's go to CNN's emerging markets editor, John Defterios. He joins us from Abu Dhabi. And John, I mean, really, when you look at this is like the richest person in your neighborhood suddenly going to ask the bank for a loan when we all thought they were swimming in cash.
How does Russia's economic situation, which everybody knows is terrible, the currency is getting smashed, interest rates are spiking, is a total mess, how does that affect Putin's leverage?
Well, I think it undermines his leverage more than it actually does, because we, in the more developed world, we in the United States in particular, see all developments through an economic lens, especially us financial markets types.
And Russia doesn't?
Putin has time, right? And he doesn't have to worry about elections.
We will rebuild, we will recover, and the United States of America will emerge stronger than before.
Tonight, I want every American to know this. We will rebuild, we will recover, and the United States of America will emerge stronger than before. And the United States of America will emerge stronger than before. We will rebuild. We will recover stronger than before. We will rebuild. We will rebuild. We will rebuild. We will recover stronger than before. The weight of this crisis will not determine the destiny of this nation.